My name is Fred Wallace, and I'm president of your chapter. We've got a couple of announcements. We were going to show some screenshots from our new website, and unfortunately, we had some computer issues, so I'll just tell you about how the website's coming along. It looks beautiful. The graphics are great. It's a huge improvement over our previous website. Our game plan, and Don Rinkin, our webmaster, is this sounding okay today? Because I'm feeling an echo. Is it okay? Okay. It sounds different. Okay, good. So Don's been working with our outside consultant. I think you'll really be happy with the website. The website should be live by the end of the year. So when we come back in January, it should be ready to roll. That's our objective. So thank you again for your financial support that allowed this to happen, and I think you'll be very pleased. Announcement number 2, we have a really strong lineup already in place for the first 4 months of 2019. Tom Petruno will be here in January on the 17th, talking about the stock markets in a general sense, and he'll be joined by Monty Gill and members from Guild Management who will be talking about their forecast for 2019. Should be a wonderful meeting. Our February meeting is Christine Benz from Morningstar. We're going to let her have both hours because she's such an amazing speaker. She'll have a 1 hour on investing and 1 hour on retirement management of your investments. Should be a great program. The third announcement is we are selling the annual season passes for 2019. I think there's a flyer out on the desk. You can mail your check in to the address on the flyer, or you can bring your cash or check to our January meeting, and it's $120 for all 10 sessions for next year. And really the big benefits of doing the season pass, it really helps the chapter with our financial management of the dollars. You get the VIP seating, your name tag is always waiting for you here, and you save about you save a third. The walk-up price is $18, the $12 for the season pass, or $15 if you do the advanced registration. And even if you miss a couple meetings, you're still way ahead with the annual pass. So if you haven't purchased the annual pass, I hope you'll give thought to doing so for next year. Okay, now, our first speaker. We are very pleased to welcome back to Skirball Doug Fabian, Executive Vice President of Mercer Advisors. Doug has been educating investors for over 3 decades. Prior to joining Mercer Advisors in 2017, Doug was president of his own wealth management firm, Fabian Wealth Strategies, and editor of the newsletter ETF Investing. Some of you may know the name Doug Fabian, as I used to listen to him on radio for many years when he was on radio, before he launched this very successful podcast. And today he has a podcast called The Science of Economic Freedom. I think he does it every week or two, almost every week. He's very educational. Doug is very passionate about helping people to educate and inspire people with the objective of achieving your own economic freedom. And he follows in the footsteps of his father, Dick Fabian, who was a pioneer in advocating investors to use no-load mutual funds. Doug is a very astute market observer and will begin his talk today by discussing the post-election environment for the markets from the recent midterm elections. He will then transition to discussing factor investing, sharing his insights on the science, logic, and research of 5 different factor models that can be implemented using ETFs. Doug believes factor investing can improve one's market results by lowering the volatility of your portfolio, and in doing so, generating a smoother ride in both up and down markets. Ladies and gentlemen, join me in welcoming back to Skirball, Doug Fabian.
Good morning, ladies and gentlemen. Great to be back at the Skirball Center. I'm looking forward to our time together. Just had a midterm election. We have to talk about that a little bit. And I hope to share with you today some wisdom and some knowledge. Now, let me talk about those two things just for a moment. Wisdom comes from time, experience, and judgment. And when I talk about wisdom in relationship to your own portfolio, it's where I have shared a concept with you that applies to you, that you believe that you can actually put to work. Now, I'm also going to talk today about some facts and figures and science. That's knowledge. And perhaps that knowledge may be applicable to your portfolios. But one of the things I really want to do today is I want to extend the relationship with you beyond just this one conversation. One of the things I want to do is invite you to listen to my podcast. It's absolutely free. There's no sales pitch. My company, Mercer Advisors, one of the things that they did when they hired me is they asked me to create a podcast for them that was purely educational, that tapped into the resources that we have at our company, and I'm honored to do that podcast each and every week. So, let me get my clicker out here.
How do we access the podcast?
I'm going to, you can go to the scienceofeconomicfreedom.com, and I'm actually going to have a postcard that you can give me your email address, and I will sign you up for the podcast. Let me turn on this device. Okay. Just to mention, because it's important, this quote from our founder, Kendrick Mercer. He said this in 1986. It is our job to help our clients achieve economic freedom. And economic freedom is another way to say financial independence. And more importantly, have peace of mind and not have to worry about money. So that's one of the things that I want to talk about here with you today is not worrying about money. I'll just mention Mercer Advisors has a national footprint. We've got 33 offices. We're managing $13 billion, and we have over 300 employees. Here's our local team. But what I want to mention, too, is so many times we have a tendency to think that the investment markets are absolutely critical to our success with our wealth management. And I would say that that's not true. There are some other disciplines that are very important. There is the financial planning aspect of your wealth, which is your cash flow. There is taxes. There are estate rules. There are other things that are critical to your legacy and your success. So one of the things that we do at Mercer Advisors is we do provide our clients with all of these disciplines rather than just asset management. Now today I'm going to talk about our investment strategies, our investment styles. And we implement for our clients a strategy that we call factor investing. And you can implement factor investing with individual stocks, you can implement it with ETFs, you can implement it with mutual funds. But there's some reasons to consider, and the most important reason is the level of success that we've had with factor investing, which I'll share with you today. But before we get to factor investing, I want to talk about the election. And certainly there were winners and losers in the election. And the big question that everybody has on their mind is this election going to influence the financial markets in any way going forward? Let me point you to the pie chart on the left-hand side of the screen, and I'm going to start to give you some hints about the answer to that last statement. First of all, it's amazing to me. This donut, this pie, represents all stocks around the world. And I think most of you know that the United States has 5% of the world's population. But we have 55% of the value of all companies in the world. And I mention that because sometimes, and again, there's just so much noise in the media today, but one of the reasons why I believe that that is true is because our system of capitalism works better than any other system of economics in the world, and we've been the best at I still believe there's as much opportunity in the United States today to be able to build wealth and participate than there ever has been. Now, I want to share with you that slice up there, emerging markets. Emerging markets represent just 11% of all the stocks in the world. This includes China, it includes Russia, it includes, more than 50 countries are in the emerging markets, and they make up a pretty small slice of what's happening in the world today. And then, of course, the developed markets, Europe, Japan, Canada, make up the rest. Now, I want to point out some statistics here. And if you take a look here, this was as of 9/30, okay, a little over 5 weeks ago. The S&P 500 was up 10% year to date. EAFE was down 1%. Emerging markets were down 7%. The updated numbers on that, the S&P 500 after the correction we had in October is still positive year to date, about 2.7%. Emerging markets are down 13%, and the rest of the world is down about 10%. Well, again, a lot of times people think, well, the U.S. continues to perform well. Why would I even want to consider investing in any of these other markets? And especially if they're down year to date, sometimes investors lose confidence in something that's off trend, and they abandon it. I want to point out these statistics from 2017. Emerging markets up 37%. The EAFE index was up 25%. U.S. was up 22%. And then the 15-year numbers. You know what's amazing to me about this column on the 15-year numbers? If we were to average it, it's 10%. The S&P 500 over the past 15 years has done 10%. International stocks have done 10%. And emerging market stocks have done a little bit better than 10%. But 10% has been the mark. So I wanted you to have that basis as we're going into the discussion here today, because I'm going to come back to some important issues about these numbers throughout my presentation. But at least we're up to speed. Hey, we're still positive year to date. There's been a cycle correction of late, but where do the markets go from here? And do the elections matter? That's the next question. So I know that this chart is busy. Let me explain to you. The top chart represents the 6-month rolling returns of the S&P 500 from 1947 to 2018. The 6-month windows, again, this average return, when it says 6 months, it means for the rolling 6-month period when Republicans were in control of both houses of Congress and the presidency, we had an average rolling 6-month return of 6%. Democrats, 4%. Divided government, 4%. There is nothing in these statistics that point out, and again, that period of time that the Republicans had at both houses of Congress was 11% of the time, Democrats 28% of the time, and we've been in divided government 61% of the time. Well, we've got divided government again, and we should expect that the market is going to continue to perform in the future as it has in the past. There is nothing in this election that is going to change how the S&P 500 performs on a going forward basis. Now, I want to read you a statistic, and this statistic was quite compelling. Since 1946, there have been 18 mid-cycle elections, midterm elections. The stock market has rallied over the next 12 months after every single midterm correction. 100% of the time, the stock market has been higher 12 months after a midterm election by an average of 17%. Now, that's an impressive statistics. And I would first say, as someone who is logical and been around this business for over 3 decades, that that's a record that's maybe broken at some point in time. But I can remember back when the last midterm election, there was a 60-point swing in the House of Representatives against Barack Obama, who won his second term. And we had a 32% year in the stock market. And when you looked at it, it looked like there was going to be gridlock and fighting and all kinds of, Obama was going to have all kinds of problems. Well, the economy didn't have problems. And that's what we're focused on. So my comment to you, my coaching to you, my imparting wisdom to you is, do not worry about what's happening in politics relative to your money. Your money doesn't care who's in the White House. It doesn't care what's happening in Congress. Certainly you need to understand the rules. We live in the state of California. We have tax rules here. There's federal tax rules that govern our lives. We need to understand those rules and manage our money accordingly. But there's nothing that's happening in Washington that is going to affect the stock market in a significant way for the next 5 years. Now, I just mentioned the next 5 years because, we're going to have another presidential election, the market's going to march on. This doesn't mean that the market has repealed the down cycles or bear markets or anything like that. But the bottom line is that it doesn't matter what happens in Washington. So you can look at it for your political entertainment, but don't look to what's happening in Washington to help you guide you on what's going on in your portfolio. Now, let me switch subjects, because this leads me into why science matters when it comes to your investment portfolio. Can I ask for a show of hands of how many people in this room have been successful with residential real estate? Okay. The people that didn't raise their hand are just lazy. They didn't want to raise their hands. But I would bet that every single person in this room has been successful with residential real estate. And now I'm going to tell you why you have been successful with residential real estate. Number one, you use leverage to your advantage. I'm sure a few of you might own a piece of property that you paid cash for, but when you bought your first home, you used leverage. You used OPM, other people's money, and you leveraged yourself for a loan. 1% down, loan, 4 or 5 to 1. So that's the number one reason why you were successful, is you were leveraged. Number two, you were using the tax code. You were using the tax code to your advantage. The fact that you could write off interest on your mortgage made it advantageous to you. But the third and the most important reason why you were successful with residential real estate in California, or virtually anywhere else in the country, is because you sat still. Residential real estate is not the kind of thing you can flip with a 6% transaction cost. Now, I'm not saying that somebody hasn't made money flipping homes, but with at least a 12-month capital gain holding period and the transaction costs, unless you're in business, it makes no sense. You made money in real estate because you sat still. There was very little movement. And I believe that there's wisdom there. Because when it comes to your investing portfolio, and now what I'm going to get into is this discussion about successful investing and why successful investing is difficult. It is because of investor behavior. Investor behavior, if we can control our behavior, we will increase our chances of success. Now, this slide is a compilation of a study that was done over the 20-year period from 1997 to 2017. It's done by a research organization called Dalbar. Dalbar looked at all of the mutual fund data for holding periods over the past 20 years, working in conjunction with the Investment Company Institute, which is the mutual fund trade organization. And they examined who had the highest likelihood of making money, what traits of investors made money, what did the average investor do? And they came to the conclusion through this research, and they've been doing this research for 20 straight years. They'll come out with another research report this year. But over this period of time, the S&P 500 did 7.7%, and the average investor did 2.3%, and inflation was at 2.1%. And the reason why the average investor is performing so poorly is because of this chart. This is the greed fear cycle. Oh Lord, I am so smart. How could I have been so wrong? Now, I'm just going to give you a couple of examples on this. And I have to go through this I can't not go through this presentation without talking about Bitcoin. And let's just look at Bitcoin from a psychological point of view. We had an investment vehicle, and I'm not going to try to explain it to you. I'm not going to try to justify it to you. I'm certainly not going to recommend it. But it went stratospheric. It went straight up in 2017. Now, it had been going up for a couple of years, but I think all of you know the end of the story. In 2018, it went straight down. And when you look at, and I use GBTC, which is a ticker symbol for a crypto vehicle, it started the year at 26, it's currently trading at 6. That's a decline of 75%. When something goes down by 75%, you now need a 400% gain to get back to break even. Okay, that's what's called bear market math. When I look at, and one of the things you can do with the tools on the web, and I have the tools at our facilities, I can look at volume. Volume is a measurement of participation. And in November and December of last year, there was a line longer than the line at the Matterhorn to buy Bitcoin stock. At virtually the absolute top. Now, just a little quick sidebar. I got into this investment business in 1979, and I was 23 years old, and I went to work for my dad, and he was just putting together a newsletter on no-load mutual funds. And in 1979, no one knew what a no-load mutual fund was. Mutual funds had a sales commission at that time, if you went to the E.F. Hutton or Merrill Lynch, of 8.5%. 8.5% was the sales commission. So we were really onto something with no-load funds and sharing that message out there the like. But it just so happened there was something going on at that same time, 1979, 1980. We were going through this tremendous rise in the price of gold. And gold went to $850 an ounce in 1980. And there was a company here in Los Angeles called Jonathan Coin. And I used to go to KWHY TV in downtown Los Angeles with my dad. And the first time I was on TV was on KY. And so I know Jonathan Coin was down there. But for some reason on the CBS Evening News, they were doing a story on Jonathan Coin. And there was a line around the building to buy Cougarans from Jonathan. People stand in the line. So line. Some people were buying lots of Cougarans. And wow, how smart am I? This has happened time and time and time again throughout my career. And when people are talking about things at cocktail parties, when everybody's relaying a story to you about how smart they are, because they bought Bitcoin at 300 and now it's at 3,000, that's not a trend that you want to jump on. Because that is going to cause some significant pain in your life. Now, I'm going to wrap up my story about this with just this thought. There's a website called Reddit, and you've probably seen it. It's just a whole bunch of conversations, a whole bunch of noise. But they have a whole section on cryptocurrencies. And when we had the first leg down at the beginning of this year, I went on to the forums at Reddit to see what people were saying. And I read this story, my wife's gonna kill me. I took our entire savings and I put it into a big currency, and it was one of those ones that just blew up and went to zero. just all agree that that's bad behavior. Okay? You know? So, but this greed fear cycle can work on you. I'm telling you right now, yesterday I'm prepared for this talk. I went to 2 websites, and the headlines, just a couple of headlines. The race for 6% mortgages. Housing bust 2.0 on its way. Flashing red, market crash, dead ahead. And then Kramer yesterday said that all stocks right now are in a serious correction. Wait for it. And there's nowhere to hide. Ladies and gentlemen, what you need to do in order to be successful at investing is remember that equities have far outperformed residential real estate. The stock market will return 9.1, 9.2, 9.5, 10%, pick your number, for the foreseeable future. But it is not going to be in a straight line. It is just not. But by the same token, you have to figure out, what am I going to own? What am I going to buy? It can be the S&P 500. There's nothing wrong with that. There's nothing wrong with owning an index. But the key is to be diversified. You must be diversified because of what I just talked about. I mean, the S&P 500 had GE in it, and GE has been an absolute disaster of a stock for the past almost 20 years. But has it really hurt the performance of the S&P 500? Maybe a skosh. But to anyone who was directly involved in GE, it's been an absolute disaster. But did you know that General Electric was the #1 performing stock of the 1990s? The #1 performing stock. And in the year 2000, stories were written that you don't need to own a mutual fund because GE is so well diversified that this is the only stock you need to own in your portfolio. And I'm sure many people did. And that stock has been going down for 20 straight years. So the moral of the story is diversification. And not just diversification here in the US, but diversification around the world. Only in some emerging markets, only in some developed countries. Because of years like 2017. Emerging markets were up almost 40% in 2017. But do you want to put 50% of your portfolio in emerging markets? No. Our strategy is we want to own a little bit of emerging markets. That might be 4 to 8% of our portfolios that are the equity portion of our portfolios. And that's the way you go about doing it. A couple more things here on underperformance. Just a couple of bullets. Reasons why investors underperform: they don't have a financial plan, they do not understand risk, they generate unnecessary tax consequences, they are poorly diversified, and they follow the trends touted in the popular press. Now, I'm not going to ask for a show of hands, but how many times a day do you look at your portfolio? Is it really necessary? Is it giving you any edge to look at your portfolio more? Now, let me go back to residential real estate. Are you looking at the price of your home every day? The most successful investment you most likely have in your portfolio, not because it has performed better than the stock market, but because you bought it with OPM, other people's money. And you sat still and you held it for a long period of time. That's why residential real estate has done so well. Residential real estate, as quoted by Robert Schiller in his study around this country, has done about 6% a year. And I'm not saying there's anything wrong. Don't get me wrong. I own my home too. Okay, but I'm going back to the wisdom of sitting still. And pick your poison. Fox News, CNBC, MSNBC, Zero Hedge. Yeah, gotcha. That's crack. I'll be going out there to Zero Hedge because you'll find yourself reaching for the shovel and digging yourself a bunker. You've got to stay away from this stuff. But what I'm going to talk about when I discuss factor investing today, and there's going to be a few lessons for you, and this is, I'm moving from the wisdom portion of the portfolio to the knowledge, presentation, the knowledge portion of the presentation, is I'm going to share with you how we go about this and why we go about it. But what we're trying to do with our factor investing strategy, and this is a strategy that you can implement on your own, and you can use it doing ETFs, is to smooth out the ride. We have all been on the portion of the plane ride where when you see the flight attendants going to buckle into their seats, you're just like, not good. This is not going to be good. When stuff's falling out of the deal, or, somebody's in here has probably seen the things fall from the ceiling. Not good. Way too bumpy of a ride. And when things get bumpy, there's a tendency to feel like, I gotta do something. I gotta take some action. I gotta get the hell out. Back up, right there. Get the hell out. March 9th, 2009, the absolute low. More money moved out of stock mutual funds than any day in the history of humankind. On the day of the low. And I'll just mention, January this year was the strongest month in the previous 5 years in terms of money going into the market. Now, I realize that in January people are making pension contributions and there's some seasonal trends going on here. But I'm like, what the hell was wrong with 2017? Why now? Why now? I mean, because it went up 22%. But isn't the idea to buy before it goes up? Nope. That's not what it is. I'm going to buy right in here so I can sell right down here. And kill myself. We've got to get a handle on our behavior. It is critical. And it's just worse than ever. I was commenting with my friend Jeff here today on the ride up. I'm on the air. I was up in San Francisco this past week, and I'm sitting on the plane, flying up there. 2 guys in front of me. The only thing I've ever made money in is real estate. And I'm really nervous about the stock market right now. I had a meeting with a guy because people recognize my face. I'm really nervous. What should I do? And I tell them, just sit still. Sit still. Do nothing. Now, if you're 100% cash, I'm not going to tell you to sit still, because if you're 100% cash, you're losing 2% a year. Can you imagine? I put a $100,000 CD at the end of 12 months, I got $98,000. I'm going to let that ride again. Going to go another 12 months, down to $94,000. That's great. That's inflation working against you. There is no better hedge against inflation than the stock market. So, let me just share with you one more slide here. This is a little busy. These bars are the performance numbers of the S&P 500. This is 1980, and the S&P 500 was up 26% that year. But during the year, the S&P 500 was down 17%. Okay, get that? So let's go over here, 2008. The S&P 500 was not up 10 minutes in 2008. Not even 10 minutes. Okay, it was down for the entire year, down 38%. But intra-year, the S&P 500 was down 49%. So it is this volatile. But you look at this over time, The market's positive 29, 38 years. Right now, we're up 2% year to date, but we've had two 10% corrections. Okay? The point is, we've got to sit still. Now, I'm also going to say, and this is leading into where I'm going to go next, is we want to have the right stuff in our portfolio. We want to have the right stuff. And we're going to talk about factor investing. Factor investing is a combination of passive investing, indexing, Vanguard kind of stuff, and just a little bit of active investing. And the active investing portion of factor investing is your asset allocation, is rebalancing your portfolio. There's a few things that we do for clients, you can do for yourself, that will increase returns over time. Now, what's a factor? And again, folks, one of the things I want to remind everybody, everything I'm going to talk about right now is based in science. It is based in peer academic reviewed research. 2 economic Nobel Prizes were won for factor investing. So this stuff is the real deal. So a factor, in order for it to be used, investable, it must meet several tests. It must have some significance, it must be persistent, and it has to be supported by rigorous, peer-reviewed academic research. And much of the factor investing story is out of the University of Chicago. Now, there's a lot of numbers on this slide. I'm just going to take you to one column right here to explain this. I'm going to talk about value stocks. You know, as astute investors, that there are value stocks and there are growth stocks. And value stocks are stocks that have a lower PE ratio. Google is not a value stock, okay? Google is a growth stock. Value stocks pay dividends. Many times banks are value stocks. But there's a way to be able to measure just value stocks. And if we look at value stocks versus growth stocks over, get this, 88 years, 1928 to 2016, value has outperformed growth by 3.59% per year. That is significant. 3% a year for 88 years. That's a good return, 3% a year for 88 years. But not only do you get the 3% return, you get the other 9% to go along with it, and you get almost a 13% annualized rate of return by just owning value stocks. So, you're going to say, stop right there, Doug. Okay, why doesn't everybody just own value stocks? Well, you go through periods of time when value stocks underperform. Value stocks right now on a year-to-date basis are down 1.5% versus the S&P 500. In 2017, value stocks were up 14%. The S&P 500 was up 20%. No, still up. This year, there's a slight variance, but they're underperforming. You go through periods of time where value will be out of favor. And I'm just going to say, I'm not going to talk about everybody in this room, but you're impatient. When something is underperforming, it's like waiting for your daughter to get home from a date. You're impatient. And you lose faith. You jump to something else. And it's all this jumping around that keeps messing you up. Now, again, this is the proverbial view. All those people out there in the 405 who are not here today are the ones jumping around. You're all safe. Another interesting, and I'm going to talk about these a little bit more. I'm just going to explain another one. This is very interesting over here. This is the size. Small caps outperform large caps. Again, by a pretty decent margin. And we all understand this. Can a small company versus a large company, who's going to grow faster? The small company's going to grow faster. Going from 1 store to 2 stores is a hell of a lot easier than going from 100 stores to 200 stores. Right? small cap stocks outperform large cap stocks. So again, the question is, well, why don't we just own small cap stocks? And I love the line from Jack Nicholson, you can't handle the truth. When the market corrects, the roller coaster ride in small cap stocks is straight down. We had a 10% correction in in the market, and small caps are down 20. They don't care. They're more volatile, and that's the challenge of hanging on. Now, again, I got to keep my presentation moving, or I'm going to run out of time. This little sequence I'm going to take you through here shows you how often does value outperform growth, small outperform large. But I wanted to start with how often does the stock market, as measured by the S&P 500, outperform T-bills? Okay? We would probably say most of the time, but not all of the time. So on a one-year basis, 69% of the time over the past 88 years, the stock market outperforms T-bills. Right now, T-bills are 2%. Okay? So it's like a dead heat right now with the S&P and T-bills. T-bills may win this year. We end up down 3%. T-bills win. You're never going to get a 20% return in T-bills. 5-year basis, 77% of the time. 10-year basis, 85% of the time. And on a 15-year basis, looking at the last 88 years, 95% of the time, the stock market outperforms T-bills. Okay? Most of the time, and especially over longer periods of time. So, value versus growth, on a one-year basis, 65% of the time, value wins. 5-year basis, it's 75% of the time. 15-year basis, it's 95% of the time. And again, I'm not going to go through all of the factors. There are 5 factors. You can see them here. But I have to manage my time. And small versus large. On a one-year basis, it's just a little over 50% that small cap stocks beat large cap stocks. It's a little over 50%. 57%. But on a 15-year basis, it's 82% of the time. I'm going to move to this next area here on factor investing. Now, I just talked about a very long period of time, 88 years. And now I'd like to talk about a period of time that's a little closer, we can all remember. This is from the year 2000 until 2017. This is what the S&P 500 did per year. Okay, there's the minus 37, the minus 22, and 3 years in a row there, boy. That tech bust was ugly. 2000, 2001, 2002, 2008. Pretty amazing that we have had 2 major bear markets in the last 20 years in U.S. stocks. 2 major bear markets. The average bear market stocks go down about 33%. This bear market, they went down 47, and this bear market, they went down 56 high to low. So those are 2 huge deals. And again, that just plays right into the headline writers, because we're going to play on people's fears, and we're going to make them think that there's another 2008 coming. Where actually the probability of another 2008 coming along like next year or 2 is extremely low. That doesn't mean that we couldn't have another bear market, but we're not going to have a bear market where that was a generational bear market that we had at minus 56%. But the headline writers would have you believe that it's starting tomorrow. Click here and give me $100 or $1,000. It's all fiction. Okay, so we got the 17-year period of time, and 5.4% was the return of the S&P 500 over the last 17 years. Let's just dwell on that for a moment. Isn't the long-term average of the S&P 500 a little closer to 10? So the fact that in the last 20, we've done only 5, doesn't that kind of give you the feeling that maybe we still have growth in our future? Something I saw on CNN Money yesterday, because I'm perusing websites and I'm preparing for this presentation. They've got a fear gauge, and I've never seen it before. Fear gauge, very high. everybody's like really nervous. The guy that I was sitting with, you know, what should I do? And he was so disappointed when I said, do nothing. Sit still. Just like my 5-year-olds in the back seat of the car. I'm gonna reach you. Sit still. Okay, so now we're using the same graph, okay? And we're just looking at how have value stocks done each one of these years. And did value stocks kill the S&P 500? No. Value stocks over this 17-year period of time just beat value stocks 1% a year. But there's something I wanted to point out to you, and that's this number. We have a tendency to forget the power of compounding. And if we got 1% better in our portfolio each year for 17 years, it would cumulatively add up to 56%. And we're just going to say amongst us friends that 56% is significant. Okay, if you can increase your portfolio over the next 20 years, 56%, are you interested? Yes. Don't raise your hand. But wait, there's more. Size. Size has done better. 2.4% a year. Look at the compounded rate of return on size. Now, these are small cap stocks versus the S&P 500. And, you know, because of years like this, you know, S&P 500 did 27. Russell 2000 did 50. Awesome. These are momentum stocks. They also outperform these little slices of the market that you can assemble that will give you better returns.